congratulations to you for showing up today. We're going to learn a ton. Whether you're a neophyte or a seasoned commercial real estate investor, you will learn something. I've been around for a while, investing for over 30 years, and I've moved from direct real estate into commercial real estate investing. Here's my first deal review, which is location, supply constraints, the sponsor, the occupancy, the rental rates, the tenant mix, and the fact that it's a unique asset. However, that being said, I did make some mistakes on this deal, and really, it's a big oh no, what happened. I reveal what I missed. Sit tight, we're all gonna learn a ton, it's gonna be fun. And if you appreciate the fact that I'm being honest and open and sharing what I missed, if you hit like, the YouTube algorithm will help spread this information globally. 10% of all YouTube ad revenue goes to not-for-profits focused on children's education. Okay, so let's get right into this. Just so you know, it's a R&D flex office space, but let's really get into location here. Location. Fremont, California is a booming market. The unemployment rate is around 2.5% in the area. There's freeway access. It's between two BART stations, which are public transportation stations that have just come in, and it's really helping the area. The property is only 2.5 miles away from the Tesla factory. There's thousands of new housing units going in, so there's going to be a supply of potential workers to work at the companies in the area. So now let's talk about the supply constrained nature of the R&D flex market in Fremont. This building is a one-story R&D flex park, so people prefer to be in one story if possible. A lot of the competing properties for R&D flex are actually being torn down to build multifamily property. So actually the supply is decreasing, not increasing. The property is actually 100% occupied, and its rental rates are around 80 cents, which is way below market, which is around $1.50 to $1.55. During the hold period of the deal, which should be about 4 years, 75% of the leases should come due, and the idea is to boost the rent. And in terms of how this rent compares to the rest of Silicon Valley, some Silicon Valley rents get up to almost $5. Before doing the deal, the average rent in Silicon Valley was $233, whereas in Fremont, the average rent per square foot was $1.48. So if there's a downturn, my thinking was that we would be protected and insulated given that the rents are so low. Now let's talk about the sponsor. They've done a lot of deals. They have a great reputation, very solid returns. Now let's talk about number 5, the tenant mix. You have 9 tenants, one of which is a very large, high quality credit tenant, a Japanese company, who is looking to potentially expand to fill out their full building. And so that gives us room to maneuver in case some of the tenants leave. If that high quality tenant takes over the whole building and signs a long-term lease, we could sell that lease out into the market and really boost the IRR of the deal, which is projected at about 22% up to maybe 30%. And finally, it's a unique asset. It has super high ceilings, a large campus, and a lot of the competing properties are being torn down. Another thing about this asset being unique is that it doesn't really need much of an upgrade. It just really needs a new paint job that's a little bit modern looking. The facility overall is very well taken care of. More of this is not being built. The land is very expensive, and the cost to recreate this would be much, much more expensive than the current price that we paid of $181 per square foot. So the build cost is a lot more than the actual purchase price. Okay, so now you know why I did the deal. So let's find out what went wrong. Oh no, I have to say, oh no, yes, that's right. Okay, so let's get right into what went wrong, because in retrospect, I did make some serious mistakes. Number 1, I got overly excited and I plowed hundreds of thousands of dollars into it. I shouldn't have. It was a huge mistake in retrospect. Now I'm suffering the consequences and realizing that I should have allocated my money much more slowly. And whenever you enter a new asset class, start slowly, whether it's in venture capital, angel investing, commercial real estate, stocks, whatever you're investing in, take it slowly and then ramp it up as you gain more experience. So that's the big lesson, is don't get overly excited in a new asset class until you really know what you don't know. This lesson is so important. I wish I had seen this video before this, so don't get overly excited on your first deal. Number 2, R&D. Okay, so flex R&D, you think it's a special market, but it's kind of really like office. And office really is not a great investment because there's so many requirements with regards to having to invest for the tenants, but also during a downturn, the vacancy rates can get very high. So now I'm feeling the brunt of that during this current recession, and I'm feeling very stupid that I invested so much in a R&D asset or an office asset almost. It acts kind of like office. And I really don't think that that asset class is the greatest asset class because I don't find it very defensive. And as a real estate investor, I like to be defensive in all my investments. 3, sponsor communication. I don't find that the sponsor communication has been particularly good, so I'm disappointed there. Number 4, occupancy and rental rates. Yes, the occupancy was at 100% and the rental rates were at 80 cents, but now that I think about the deal more carefully, those tenants had come there during the last downturn and they wanted a lower rate, and that's why they moved there for the 80 cents. Now that we've hit a downturn and we're trying to raise the rates, these tenants, if you look at their psychographics, they're looking for a deal. Now they're not getting a deal because they have to pay market. So it just happens that 3 tenants out of the 9 have left and now we're only 64% occupied. So that's a big problem. I should have seen it coming, and at the least, given that the vacancy rate in Fremont was 9.8%, I should have realized that this building could quickly go to 9.8%. But now we're 64% occupancy. So that's a problem, and shame on me. Number 5, tenant mix. I was so excited about the credit tenant, and I was thinking they would expand to one of the full buildings, and then we could sell that long-term lease into the market and boost our IRR from 22% to 30%. However, now that I've looked at over 165 deals, I realize that having a huge tenant like that is actually a negative because they could go away. Luckily, they haven't gone away. Now I'm realizing it's not particularly a unique asset, and during a downturn, R&D parks can be affected. So in short, what I learned was don't get overly excited. R&D isn't particularly recession-proof. You want a sponsor that you know has great communication. Don't get thrown off by the 100% occupancy if you're doing a purchase, because your property could go to market or below. And with your tenant mix, don't put too much weight in having a very large, high-quality tenant in a building because they could disappear. Don't necessarily think your asset is unique unless it truly is. So I hope that you gain something out of this so you don't have to go through the pain. Stay tuned and subscribe to the series because this is one of 16 deals that we're going to review. So let's continue on this epic journey to wealth. I love you guys, and thanks for your support.